I'm going to give you one of these one actually.
All right, good morning, everyone. We are live right now. We're starting in about 1 minute, so good morning and welcome. We're excited to have you here. Just wanted to open up the live stream going so you know we're going to go live soon, so give us about another minute or so, and we'll start the presentation up to the best retirement strategy that I have ever seen, so stay tuned. All right, well, let's get started here. Good morning. My name is Chris Gervat. I'm a lead advisor at LifeWorks Advisors, and we're really excited to have you on board this morning. And before we kind of dive on into the best retirement strategy that I have ever seen, I kind of want to give you the lay of the land and what to expect moving forward. Number one, we are live. This is a live presentation. So with that, we have some little things we're going to be doing here. You have the ability to ask us questions as we do this. And the way you do that is you go to the button down below here. It's lifeworksadvisors.com/one-on-one. Now that will take you to a separate screen. You'll still hear us. This link will still be going. From there, you can ask us a question. On top of that, you can also schedule a meeting. Now on top of that, that little green button is the lower right-hand corner of your screen. You click on that, and that's how you ask your question. Within those questions, though, I'm going to save most of those towards the end. We do have Eric Olivero, one of our lead advisors, also on to monitor those if something is more pressing. But again, we'll save those towards the end. We are live again. This will last about 45 minutes, depending on all the questions you have. To my right, I have Skyler Mills. He's our Director of Business Development. I might look this way, and also the slides are up and to the left here. You're right, and that's where I'm looking. So if I drift this way, that's the reason why. So with that, let's get started with our presentation. So starting out here with our introduction, going to talk just a little bit about myself, but we're more here to talk about you and your situation, how we could possibly help you with the current investing environment. The challenge has to do with predictable income and how to control that more in retirement, because again, we cannot control the markets, we control what we spend and what we save. 3 mistakes you make that could make or break your retirement. Some solutions on how to navigate our LifeWorks strategy, our next steps, and Q&A. Now, before we go forward, I do want to take you to the right side of your screen right there, and that word. That word is durable. Just want to define that for you quickly, and that is able to exist for a long time without significant deterioration in quality or value, lasting, stable, permanent, enduring. And throughout this presentation, I'll ask you, do you have a durable investment strategy? All right, let's move on here. And before we do, though, I just want to make sure we gauge the audience the right way and make sure that you're in the right spot. This is geared towards those who are at or near retirement. Now, if you are in your late 40s and 50s, there's for sure some great information here. But with that being said, we're talking about predictable income in retirement, cash flows in retirement, so you can stick around, but again, more geared towards those at or near retirement. Now, going into this again and being redundant with predictable income, the challenge is just this, and that is how to generate predictable income and real positive returns in an increasingly volatile market and unstable global landscape. We'll talk more about volatility and the global landscape as we go forward, but the big thing is as you retire, you're turning off that sink, that faucet to give you income. Of course, you have it from your assets, you have it from Social Security, but how do we make this more controllable and predictable? Let's advance forward here and talk a little bit about why we're here and why I'm here again, very, very short. And I've been involved in the world of finance for about 10 years now. And I got my start working for a company that's worth, has a revenue of roughly $10 million a year. My job as part of the upper management team was to help run about 8 of the 15 territories across the country. And my job was to do everything to help them run those businesses, from cash flows to budget to hiring to firing to their OKRs, their objectives and key results to get them from point A to point B. Loved the job, had a lot of fun doing it, but young family at home, and traveling 7 days a week sometime was not the best path for me. So was approached by a wealth management firm, about a very well-known wealth management firm, roughly 5 years ago, and they said, hey Chris, you're doing this work for these franchises. You're helping them with their processes, their planning. What if you did it for our families in our firm, as well as the small businesses that we oversee? And it was a local from where I'm from, and I said, hey, that could be something that I can wrap my arms around. And from there, about 5 years ago, I started working for this well-known wealth management firm. And the level of service to the detail they were giving their clients and families and small businesses, to me, just wasn't as in depth. There weren't enough actionable items or things being done. And that's how I found LifeWorks. Now, LifeWorks is one of the fastest growing wealth management firms in the industry today. And it's not because of some gotcha scheme, not because of some product they're selling. It's literally because they have the best retirement strategy that I have ever seen. Now, if you're someone looking to get rich quick, if you're someone looking to do it yourself, maybe, it's not going to be the right place for you. So let's get this going and talk more in detail about what we can do and how we can help, and what mistakes that we can help you avoid. Now, the first mistake, and again, these are not in any particular order. The first one is not holding enough cash and safe assets. And there's two reasons why we believe that we should be holding cash. Now, the first one is for investment decisions. Systematic rebalances, let's just say that it's 2018, your portfolio is sitting at 50-50. We're down a couple percentage points in the S&P and the overall market. Well, what you do is take the cash you have or fixed income, you buoy that up to your equities, and you balance back up to 50-50. Active investment decisions is good old buy low, sell high, because everybody trims at the top and uses that cash to buy at the bottom, right? We use that cash at the right time, not using emotion to do that. And that's active investment decisions. On top of that, volatility reduction. And I want to tell a story a second from one of our founders and president, Ron Bullis, of what he says about this. And volatility is here, and it's here to stay. You know, volatility reduction can be used kind of geared back towards that first scenario we talked about with your 50-50. Let's just say it's 2008 and the market's down over 50%. Well, then you're only down 25%. That's still a large number. And did the fixed income actually help you out? So going back towards volatility, again, not going anywhere. And it's for a couple of reasons. And Ron Bullis, again, one of our founders and presidents, talks about the democratization of finance and trading, the ability to trade from the palm of your hand. You see, owning a stock is owning a slice of a company. And back in the 70s and 80s, the holding period of a stock, or owning it, was roughly 5 years. Nowadays, with the advancements of technology, with the internet, we have Robinhood, Betterment. We can trade stocks very, very quickly and almost gamify it with a touch of a button. And that means we're trading more frequently, which means we have added volatility. Now, we've seen this with GameStop. We've seen this with AMC. GameStop today and yesterday, again, is going back up again because the individual investor is helping move the needle now. Back in the 70s and 80s, even when I entered the market roughly 4 to 5 years ago, they told me the individual investor cannot move the market. Only the big boys can. We call them institutional wirehouses can. That's not the case right now. So volatility is here. It's here to stay. And we'll see the drastic drawdowns and pull-ups as we've seen over the last several years. Sorry for that quick tangent there. Now, income generation is the main reason of why we want to look at holding cash. And that's used to generate predictable distributions from a portfolio. So now we're going to talk about business cycles as well as market cycles. Now, the first thing we want to focus in on is that business cycles actually happen more often than you would think. So, and contractions happen as well. We'll talk about that. Now, why do business cycles happen? Number one, we've had 34 of these from 1854 until now. It's not registering 2020 yet because the National Bureau of Economic Research has not input the data yet, so we have had 34 cycles. That means we have roughly one every 5 years. So what causes a cycle? What causes a contraction? And what's the length of these? So length is roughly on average 18 months. So we talk about predictable income. We want to make sure our clients have predictable income. So that tells us we need at least 18 months of cash on hand to cover a peak to trough. Now, what causes this contraction? There are a couple of reasons. There's a couple of reasons I want to talk about. The first one is in regards to actually interest rates, the cost of borrowing money. If interest rates are really high, the cost of borrowing is high, we're less likely to borrow money to buy goods. On top of that, if you lack faith in the economy as a whole, you'll be a better steward of your cash. And because of that, we'll have a contraction. You won't go buy a car. You won't go to Starbucks and buy 4 coffees a week. The U.S. economy is driven by the U.S. consumer. 70% of the U.S. economy is based on the U.S. consumer. So if we stop spending money, we'll have a contraction in the market. So again, 18 months is the number we're looking at there. Going ahead to our next slide, we want to kind of change your focus here and talk about one thing. I want to ask you a question before we advance forward, and it has to do with rolling periods of returns. And the first question is, before I get into that is, the average return of the S&P over the last 150 years has been probably, 8 to 10%. It has been 8 to 10%. But the question is, how long is your retirement? Your retirement is 10, 20, 30, 40 years. So those rolling averages don't work out. So the big question is, over the last 100 years, how many 10-year rolling periods did we experience negative returns? So again, last 100 years, how many 10-year rolling periods did we experience negative returns? And what happens if you retire during that stretch? And the answer's on the board right there to the left. We've had 5 10-year rolling periods, and we'll talk about this more in sequence risk, where when you retire is really important to the assets in your portfolio. Now, what's the duration to a bear market? Remember, a bear market and a business cycle, they're tied together, but they're not exactly correlated in timing. So a bear market is defined as a drawdown of 20% or more, and this has happened plenty of times over the last 100 years. Dating back to the Great Depression, we had a 34-month period where we had a drawdown of 86%, and it lasts, again, 34 months. So what we're trying to do is get enough cash on hand to make sure that we have protection in those bear markets, those rolling 10-year periods, and those business cycles. If we look back to 1987, we had a Black Monday where in one day we were down 20%. And even going back to the pandemic, we had 2 days in March, we're not back to back, but we were down 10% in those 2 days. So what do you have right now in the portfolio to give you predictable income? And what's in there to help you have something that's inversely correlated to when everything else goes down? So again, the whole thing in here is predictable income. Want to have at least 3 years, 36 months cash on hand to weather this storm. Let's advance forward here. Now, again, predictable income. It's hard to have this if we have too much debt on hand. And because of rates being lowered over the last 20 years, especially after 2000, 2001, 2002, dot-com bubble, 9/11, the rate of borrowing has increased dramatically. We've had rates close to zero for almost the last decade. Household debt has doubled since 2003. Look at this chart. Household debt, $7 trillion, 2003. And 2020, 2021, we're sitting at roughly $14 trillion. And again, a lot of this is because borrowing has become cheaper. We're buying houses now. $9.4 trillion of that is composed of mortgages. But there's 2 key stats here that I want to show you. And those are the household debts of those either entering retirement or in retirement. So household debt for those 60 to 69 has gone from the Great Recession until now from $1.47 trillion to over $2 trillion. On top of that, your baby boomers and some silent generations who are hopefully in retirement, they have doubled their household debt from the recession. So we've learned some things from the Great Recession, but then again, now we're spending more money and people are borrowing more and have more debt entering retirement, leading to less predictable income. On top of that, businesses have the same issue. Cost of borrowing has gone way down. So because of that, they borrowed more money. Since 2008, they have doubled their corporate debt to $10 trillion. Now, what are they doing with this money, and what are households doing with extra cash they have? Do they have a rainy day fund to protect themselves against a black swan event like we had during the pandemic? Well, no, these companies didn't. So what they use this cash for that they're borrowing all this money for? Well, they use it for mergers and acquisitions, buying other companies. They use this to pay out dividends. They use this to buy back stock. So they're not being good stewards of their cash. Neither are current households. So if we'd have illiquidity in the system and not enough cash to pay off our bills and pay expenses, what does the U.S. government, the Fed, have to do? And the next slide will show us is that they have to pretty much create money to give liquidity into the system. So before 2010, you can see the Fed balance sheet roughly had about $1 trillion on its balance sheet. But as we entered into the Great Recession, the mortgage-backed security crisis, we injected roughly another $1 trillion into the market to free up more liquidity. And then from there, we did something called quantitative easing, a fancy way of saying creating more dollars and buying back treasuries to flood more money into the system. Kind of leveled things out into 15, 16, 17. Jerome Powell decided, along with the other members of the Fed, in 2018 to say, hey, let's destroy some dollars and increase interest rates. The market did not like that very much. And then, of course, what happens next? The great pandemic, and we inject another $3 trillion in the system. The Fed now has $7 trillion of cash on its balance sheets. And what happens, or what's going to happen if we keep injecting cash? What happens to our borrowing power? What happens with inflation? Lots of questions that have to do with fixed income moving forward that we'll go into. So Alan Greenspan, an ex-Fed chair, had a great quote, and it was discussing what was learned from the Great Recession. And he said in the short term, we learned a lot. In the medium term, we learned a little. And in the long term, we learned nothing at all. And that is the historical precedent. Let's go back a couple of slides here to show you again the household debt. And we can see that during 2008, our debt started to peak a little bit, but thereafter, people said, you know what? I'm worried that my accounts are going down. My 401k has dropped significantly. I'm going to be a better steward of my cash. I'm going to save more dollars and have less debt. But the further we removed ourselves from that situation, from the recession, people started borrowing more money. So history doesn't repeat itself, but it often rhymes. So what happened in 2008 happened again during the pandemic, and we'll likely see that again at some point. So again, be a good steward of your cash, predictable income, hold more cash on hand. All right, so mistake number 2 has to do with ignoring tail risk and not having enough downside protection. So what is tail risk? Tail risk is 3 standard deviation moves away from the current price. Great, Chris. What the heck does that mean? That means a black swan event. That means a pandemic. That means a great recession, a 9/11 event, a dot-com bubble. That means something that we can't foresee from happening. We can't predict it, and we can't prepare. We can prepare by investing the right way, but we can't predict this with everything else. Now, on top of that, the downside protection, again, we'll go over it in this slide in a second, but what do you have in your portfolio that works the opposite direction of your equities in your stock? What is going up when your equities are going down currently in your portfolio? And on top of that, you might not have that durable investment strategy that we talked about. And that was, you went to your advisor and you said, you know what, I'm worried. And they came back to you and he or she said, don't worry, you'll be fine. And that tells us that that strategy does not exist. So we want to go into this showing, what is correlated and what is not. It has been long thought that conventional wisdom tells us that the correlation between U.S. stocks and bonds is negatively correlated, meaning when one is going up, the other one's going down. So before we look at the chart here, focus more to the left, I want to read through a few of these things here. Conventional wisdom says equity and bond returns are negatively correlated. The relationship is natural and enduring, and adding bonds to an equity portfolio reduces risk and works as a hedge amid market corrections and bear markets. But the chart to the right shows exactly the opposite. In reality, equity-bond correlation it's non-stationary and it's volatile and at time is varying. On top of that, it's not easily explained by fundamental factors. And the equity-bond correlation tends to spike during the financial crisis. Now let's shift to the right. Look at this chart here. What do these numbers mean? The column on the left, 0.6 down to -6, down to -1 means that something is negatively or inversely correlated. That means when something is going up, the other one is going down. At the same time, if we hit 1, that means that they are perfectly correlated. They move in tandem together. So in 2008, Great Recession, we start seeing something happen. Stocks and bonds become more correlated when we have a financial crisis. Things quiet down into the early 2010s. With an unexplained shift in 14-15 tied to negative interest rates. But change your focus back to COVID, back to last year. And this chart is actually condensed and it actually shoots up to 1, meaning that bonds and equities were actually 100% or close to it correlated during the last financial crisis. So again, what do you have right now in your portfolio that is inversely correlated to protect you when the market does drop? And right now, fixed income is not doing it. It did maybe in the 80s and 90s when return rates and interest rates were in the mid-teens in the 80s and the 90s in single digits. But right now, with the 2-year Treasury yielding us 0.12%, that's not doing the job for us. And we'll go more into that inversely correlated thing to help protect your predictable income moving forward. So before we move forward, I do want to talk about S&P price action over the last 40 years or so. So we're going to look at two instances here, two time frames that we'll be tying in to our next slide, and that has to do with sequence risk. So let's look back to 1980 to 1999. And we can see that during the 80s, those big gray bars, those are your recession periods. We had obviously inflation issues back in the early 80s. If you bought a house in 81, 82, you paid close to 18 to 19% interest rate. Pretty crazy, pretty crazy. Early 90s, we had some issues with energy. And then here come the 90s with the advent of the next best thing possibly, and that's the internet. And some could argue that it is. It's allowing us to communicate right now and have this conversation. But with that, there were tons of companies that got involved and people threw lots of dollars into this environment. And a lot of those companies did not do so well and the bottom fell out. Now on top of that, you pair into that the horrific event of 9/11, and we had 3 consecutive years of negative returns in 2001, 2002, and 2003. From there, the Fed and the government said, you know what, let's lower interest rates way down. That allowed for better borrowing. People bought houses. Banks like Lehman Brothers decided, you know what, let's get out of asset management and let's go into mortgage-backed securities and actually make them a tradable product and sell them because those are safe. Well, it turns out they didn't package them the right way. They weren't safe. That's a completely different conversation to maybe have at a different time or maybe on you on a phone call. But again, we were down 56% at that time. We go back up again, and we're kind of during the 2010s, low interest rates. We have slow growth here, which is actually pretty steady for stocks. We had that little bubble right there where Jerome Powell again increased interest rates and started to destroy some dollars. And the pandemic hit, and we're down 33.86%. And again, back in the 70s and 80s, you had the fixed income in your portfolio. If the equities weren't yielding a good number, you would get a return in the fixed income. But what's doing that for you now and how you having that predictable income? To our next slide, we're gonna go over sequence risk. And the sad thing is, those 10-year rolling periods we talked about before actually play a part in your assets moving forward. So you cannot time when you retire. You can for a couple of years, but not a decade. So what we have here is sequence risk. And that's the risk that the timing of withdrawals from an investment account will have a negative impact on the overall performance of the account. Let's look over someone who retires in 1980. And from there, we're going to span down for about 20 years here. And again, this is just for educational purposes alone. This is not how we do things here. In 1980, this person has, we'll call him John Smith, $1.5 million. He takes a 4% withdrawal for his distributions, and we raise that at the rate of inflation moving forward. On top of that, we invest everything into the S&P. Again, not how we invest, just educational. With those distributions, over 20 years, how much money does he have left in his account? And he has $23.945 million. A lot of you would be really happy with that kind of return in the portfolio. In fact, a lot of insurance companies use this time frame to show what your returns could be and what you could use as a basis for your withdrawals for a certain percentage of an annuity or something like that. Now let's flip the script here and go from 2000 through 2019. Now, a rough start with, again, dot-com bubble bursting as well as 9/11. Again, same scenario, 1.5 million, 4% withdrawal, increase this with the rate of inflation, and we strolled down to 2019. Just because this person, John Smith, retired 20 years later, his account now is sitting at $495,000. A $23.4 million difference just because he retired at a different time. Now, what if he had some more predictable income? What if he had some downside protection within that? And that ties into our next slide here. And this is something that we do here. This is not exactly what we do, but this is a put strategy. And what we have here is SPY. SPY is the ETF that tracks the S&P 500. On January 20th, 2020, we go out and we buy 300 shares of SPY. The cost basis is $96,000. Now, on top of that, we also buy a January 21 290 put. Now, what is this put? What does it do? The put is a contract that we buy that allows us, gives us the right to say, if we go below 290, we can sell this stock or this ETF to the person we enter this contract with at 290, which means we have a 10% floor that we're willing to take, a risk willing to take, in order to get some growth in our stock. We want some less volatility and want to enter this contract to protect our assets more. There's a cost to that, obviously, and that put costs us for 3 contracts $3,300. Now, what happens on March 23rd? This is close to where the bottom of the market is. We owned, again, SPY shares. They were valued at $96,000. They're now valued at $67,000. We're down 33, 34%. But that put option that we bought, that actually acts as an asset. Now it's in the money, as we call it, and it has a value. It's exploded in value. So that put option is now $21,000. That's that red line in the bottom towards your left. That's the thing acting in the opposite direction to help you with your portfolio, to give you more predictable income. All right, so that gives us a little satisfaction knowing that the blue line there that the S&P represents, down 33%, the green line is a combination of our shares of SPY as well as our put contract, giving you, again, predictable income to replace maybe what fixed income used to be in your portfolio moving forward. We'll talk more about, again, a little bit more about our protected portfolio as we go forward into this. So again, predictable income, what do you have right now that is inversely correlated to your stocks and your instruments you have to invest in that's going to help you sleep at night when we have a drastic turn down with added volatility in the market? Now, mistake number 3 is not having a durable investment strategy or system for how to position your assets in the market. We're going to define a couple of these things right here for you. So first, what is an investment system and strategy? All right. A system is a set of principles or procedures according to which something is done, an organized scheme or method. It's a regularly interacting or independent group of items forming a unified whole. Okay, so what is a strategy? A strategy is a plan or action or policy designed to achieve a major or overall aim. So an example of an investment strategy that we might give to our clients is to provide financial independence by generating enough annual income in retirement to cover living and lifestyle expenses while protecting investments from large losses or permanent impairment of capital. So there are a bunch of different investment systems that you can use and you possibly have used through your current advisor or just yourself if you oversee your own assets right now. Now, the first one is risk tolerance based, and we are not a huge fan of this one. And that's if you go to your advisor, they give you this test and you scored a 60, which means for your investments, you're going to be 60% in equities and 40% in fixed income. And again, our founder and president, Ron Bullis, has a great analogy, and it goes like this. So you're not feeling good, so you decide to go to the doctor. The doctor runs some tests, and they come back several weeks later, and the doctor says, "I'm sorry, I have bad news. You have cancer." He or she then takes their script, flips it around to you, and says, "All right, how much chemo and radiation do you want?" And your immediate response is, "The least amount possible to cure me of my cancer." You see, it's not the doctor's, or it is a doctor's job to tell you exactly what you need to get you the best outcome of surviving this horrific event. At the same time with advisors, it's our job, given the scenario you give us with the cash you need, with your current assets, to make sure that we're doing all we can to get you from point A to point B the right direction. Now, risk tolerance is based upon emotion. If you want a proper risk tolerance questionnaire, you have to answer one 365 days a year. On top of that, your risk tolerance changes every day. If you got in a car accident yesterday, there's a good chance that today you're going to be driving a little more risk averse, less tailgating, and be a safer driver. So again, it's their job to tell you what should be doing based upon what you want and the results you're trying to achieve. Gut feeling, again, going back to emotions based, you knew it all along. And a great quote here, and it says, "Even if we are aware of our biases, we must recognize that knowledge does not equal behavior," meaning that our emotions take over situations, not just in the market, but in life. You know, we're irrational sometimes. We should be the most rational. We're at the bottom of the market, everyone's selling out. That's a time you should be possibly buying more and using some strategies and lined up to get you from where you want to go. Rule of thumb is, example here, 100 minus your age of 70, that means 30% should be in equities, the rest should be in fixed income, 4% distribution, but that might not get you the income you want or need in retirement. And the last one is a tag along where you can subscribe to a newsletter or trading investment service and use their recommended buys, sells, or strategies to build your investment portfolio. And again, they don't know what you really need, and this could be some good stocks and options, but not tied into exactly your current situation. So what we have here is actually an example of a current client we have. Let's just call them Bob and Jane Smith. They're trying to retire in the year 2021. Our primary objectives for them are to provide financial independence for Bob and Jane, and it's defined as providing enough annual income in retirement to cover their living and lifestyle expenses, protect their investments against large losses or permanent impairment of capital, and last but not least, they really want to leave a legacy behind for their children and their grandchildren. So what we do is we input all their factors, just like a lot of advisors do. We look at their income through pensions, Social Securities, look at their assets, their budgets and spending from living expenses, lifestyle, travel, and whatnot. We input that, and we're trying to figure a couple of factors out. Going to the next slide here, what we're trying to do is look for their financial independence number. And their financial independence is achieved when the total current value of their assets, in this case, $1.4 million, is equal to or greater than the present value of all future cash flow needs. So what we do is we look at your spending over the next 30, 40 years. We bring that down to the present value, and we use a rate called the discount rate to do this, which turns out to be your minimum rate of return. Now, we're not trying to just achieve this, but this tells us what we need to get to in order for you to live the life that you want to live. Now, this is a calculation that can be done in Excel. It's a calculation actually used to value companies using intrinsic value and free cash flows. We won't go there. But what is different with what we do here is on the next slide, and that's our retirement income system here at LifeWorks. And we talked about this before. Again, I'm kind of beating this down a lot with predictable income. And our tranche one is correlated to the first 3 years of retirement. We want to weather the storm of a business cycle, a bear market, that black swan event, right? That tail risk event. And for their case, they need about $172,000 in those 3 years. Now from there, years 4 through 10, this is where we put in our protected portfolio. We put that downside floor on our investments to make sure we can only lose so much. Again, kind of replacing the fixed income of old a little bit, but we want that return in the market because fixed income is not getting us return in the market. So that means for years 0 through 3, we have cash. 4 through 10, we have protection, predictable returns to the most point in our portfolios there. Years 10 plus out is when we're investing in a longer term equity portfolio with good blue chip stocks, dividends for good growth, long-term stores of value. Now every year we roll this forward. So that means in 2022, we're going to have 3 years of cash. Years 4 through 10 beyond that, we'll have again, protection in the portfolio. And years 10 plus out, we have invested in again, good long-term stores of value. So we're trying to make sure that we have predictable income based upon the cash flows that you need, which is different than what everybody else needs. So a pretty important way that we're different than most other places. So options for navigating retirement challenges is number one, you can do it yourself. You can build your own portfolio. You can try to time the market, which you and I know that never, ever works. You can become an options expert, and we can talk to our Chief Investment Officer, Derek Vermeulen, who has spent 15 years at the Chicago Mercantile Exchange, where he worked really hard, had a lot of wins and failures, but it took him many years to get really good at this, and not something the normal individual investor should really be diving into. You can also chase high dividend paying stocks, and what comes to mind are REITs, real estate investment trusts that kick off some high dividends. But when we have crises, when we have events, those dividends are not guaranteed, and dividends are never guaranteed. You can also take a more passive approach and use broad market indexes while reducing exposure to equities. We talked about this, and we talked about limiting the amount that you're putting towards equities and putting towards fixed income. That's not getting you the return that it used to get you. Other one is using other indexes or passive investments and just hope that the long-term averages will align with your timeline. The good old hope and pray method, which leaves us a lot of sleepless nights for sure. Now, option two is something that I know fairly well. I spent a good amount of time at a traditional firm, and that's work with a traditional firm. And in my eyes, they have a limited understanding of your financial needs, picture, and strategies, mainly because a lot of them meet with you once, maybe twice a year. And are they really diving in to what matters most to you and aligning up your cash flows to what you need? You know, one time a year, that doesn't allow to have a lot of actionable items. You know, we have to make sure that on our end, we wouldn't need to do a lot of little things well over time that give us huge impacts over time. And one meeting a year does not do that. That's why we meet our clients 4 times a year. When we onboard someone, we meet at least 4 to 6 times to get them going. So big difference right there. Risk tolerance questionnaires, we talked about our strong distaste towards those. in a confusing 83-page document meant to just kind of get your assets over with no actionable items, bar charts, graphs, and nothing really to move forward with. And on top of that, probably the biggest thing is they're not incentivized to spend time doing real financial planning. Here at LifeWorks, we charge a fee for financial planning. I'll go into that more in the questions and answers. I'm sure you'll have questions about that. And that's geared towards what you need. We want to give you value before you move assets over. We have to build trust with you to show you we're going to do great work with you for your investment strategies. Of course, we talked about that. But we also do great work for tax planning, for conversion strategies, for estate and trust planning, life changes, family changes, divorces, grandkids, things that could be happening. So with us meeting that often, we see those and can act in real time to make changes to your portfolio. So your third option is this. It's work with us at LifeWorks. We talked about the financial independence, and we prepare, again, those personalized cash flows that have to do with how you're living your life. We figure out what that minimum rate of return needs to be. And again, we're not aiming just for that. We want higher returns, but we know we have to achieve in order to have the success for you guys to live intentionally. On top of that, retirement income system, our tranches set up for predictable income during retirement, and that allows us to position your assets for your cash flow needs. We have our hedging strategies in place to put some protection on your portfolio to make sure that when times are going bad, the advisor's job is to limit downside loss. Anyone can do really well when the market's going up, but what is your advisor doing when the market's going down? And then from there, we implement and we adjust. We look for investments that are long-term stores of value and provide real positive returns, over a lifetime. So execute trading, and again, we do with taxes, Social Security analysis, a lot of factors throughout the entire year. So here is an example of our quarterly planning. We start every year as pretty much our reset button in family strategy and plan is look at your values and vision. So we have to make sure that every dollar has a plan is intentional. With that, what we mean is things change. Values don't change as much, but goals do. So if goals change, you're going on a big trip or there's a wedding or you're buying something different, that's going to change how we're allotting cash, which change your investment strategy moving forward. Quarter two has to do with insurance review, tax planning. We hit up tax planning twice in Q2, also in Q4. Q3 is family investment systems, performances. If you own a business, we'll help you with your plan for that. Also, if you own real estate, we'll go over your ROI, your rate of return, and also dive into if this passive income strategy makes sense for you. Quarter four, we wrap up the year with estate planning, what changes need to be made, what giving has to be done, and again, look at, hey, should we do Roth conversion strategies? We want to make sure that we pay Uncle Sam the least amount of money possible the right way. So again, 8 different points we touch on over the course of the year after we onboard you for 4 to 6 meetings. So pretty in-depth here. Now, wanted to go over again how protection works through our protected portfolio. Now, typically, hedging is done for people that have 15, 20, 30, $40 million. Our Chief Investment Officer, Derek Vermeulen, has brought this down to the household level after his 15 years plus of experience doing this. So how does it work and how does it perform? Well, we're comparing it here to the SPY. Again, it's the ETF that tracks the S&P 500. Looking through the year, we see that during March, SPY again was down 33 to 34%. With that being said, our portfolio was down roughly 5 to 8%. As we've gone throughout the year, we've seen the SPY has outperformed, but we're not trying to outperform the S&P. We're trying to show you a different way of almost replacing that fixed income that doesn't exist anymore. And on top of that, what were to happen if this was 2000, 2001, 2002, where we had 3 years of negative returns? All right, wouldn't you feel better if we had predictable amounts in your accounts to allow it to give you the income that you need in retirement? So a pretty important part for us and what we do here to give our clients, again, predictable income. So just want to go over a couple of things here again to kind of summarize what we talked about. The first is the challenge, and that's how to generate predictable income and real positive returns in an increasingly volatile market and unstable global landscape. The 3 mistakes we can make, again, not holding enough cash, avoiding that 3-year stretch of bear markets, business cycles, ignoring tail risk, that black swan event, downside protection, when your portfolio is going up, when your portfolio is going down. And on top of that, not having a durable investment system and strategy. So here's our offer right here. over the next week or so, we're going to offer about 5 to 7 slots to give you a meeting one-on-one. And we're going to give you a nice little review of your current retirement strategy. We'll give you expert advice. And you do that by clicking on the link below, not link below, but below the screen, lifeworksadvisors.com/one-on-one. About, again, 5 to 7 groups. If you think that your retirement strategy can use a little tweaking, if you think that your advisor maybe isn't doing enough for you, then maybe our strategies and our in-depth look would make sense. Again, when we're starting out here, we're not requiring our clients to move money right away to work with us. Again, we charge a fee for planning. So that allows our clients to say, hey, listen, let's take this out for a little test drive to see if they give us value. We have to give you value with planning. Once we give you value, you have the right to make a choice if you want to work with us or not. And again, the barrier of entry is pretty low with our fees for planning. And you can cancel anytime. There's no contract, something you're locked into. It gives you flexibility to work with us to see if we're different and if we give you value. If we don't, you can fire us, get your money back, and you're good to go. So love the opportunity to work with you. Again, lifeworksadvisors.com/one-on-one. Our meeting with myself, with Eric Olivero, Trevor Herron will bring a couple of advisors in as well. They'll be excited to talk to you and help you out with your current situation. Now with that, we're going to go to our Q&A session right now, and we have some questions up here. And we're going to scroll to this when we can. And the first question that we have is going to be, what are our fees? Well, that's a great question. Well, our fees are different compared to what you want. So simply speaking, if you want us to do a review of your investment strategy, your financial independence number, your minimum rate of return, and some tax strategies, that's our essential plan, and that runs around $100 a month. From there, we have our family plan, which has a little bit more depth to it. So that has Social Security analysis, some tax audits, it has 529s, it has trust and estate planning, and a little more meat to it. And we can kind of blend the two if you don't think that you need everything from the family plan. On top of that, we have a bigger plan also that's more built for small businesses.
Chris, could you explain how they would ask a question?
All right, again, if you want to ask a question, if you click on lifeworksadvisors.com/one-on-one, there's a little green button in the lower right-hand corner of your screen. You click on that, and you can ask us a question right there to make sure that you can get here. All right, answer your fees. How do you guys help us protect again? So again, that has to do with what we do with hedging. We buy that put option. And that put option, what it does, it's a contract that we put a floor into. So let's just say we buy shares for $100. If we buy a put contract at 90, that tells us that we have the ability for the person we enter that contract with to sell them those stocks at 90. Even if that stock drops to 50, we have the option to sell them at 90, locking in our 10% drawdown and not going any further than that. So again, it gives us the option to do that. We don't have to. I don't want to get more complicated, but that the put option is also an asset that we can sell to get some more upside into your portfolio when we're seeing your portfolio going down. So it's a great question there. Be happy to talk more about our option strategies on a phone call if you would like to. All right. Are there long-term contracts? With what we do, there are no long-term contracts, nothing to sign on to, nothing locked in. If you cancel in the first month with us, you get all of your money back. And also, if you last 45 days, we prorate it, so you get your money back as well. So again, we have to show you value first. It's important for us to show you that and build trust before you roll assets over. Typically, people give you a financial plan for 83 pages, and they're doing that to make sure that you're bringing your assets to them. But for us, we're doing this first to show you value, and then if we are, then you bring your assets if you want to. You don't have to, but we can do the investment side. Our team does it extremely well. Where are your clients located? Great question. Because of this next best thing that we have here, the internet, our clients are located all over the country, from Hawaii down to Florida, up to the Northeast. We have clients all over. Before the pandemic, we actually do a great job of getting out to our clients one time a year. Since that's happened, we haven't done that. We're hoping to get that going again soon after the pandemic has come to an end. Okay, what are the majority of retirement savings? What if the majority of savings are currently locked up in annuities? If that's the case, and if you're locked up in annuities, there are different ways of doing that. If you like your strategy with annuities, and to be frank, we think they serve a purpose, but for us, we want to provide liquidity for our clients. And if interest rates were a lot higher, and again, annuities are linked to having to invest at interest rates, returns aren't there to match. So if they were, there could be ways to get around that, but we would be very strategic and to say if it's locked up here, do we want to keep it there? We still advise clients with annuities. We're still advisors for that, but at the same time, if we want to change it, make it more liquid, it has to be a good strategy to make sure that we're not creating taxable surrender charges and whatnot to make sure that you are not affected by that. So it can be done. That's worth a conversation to be had moving forward. All right, Skylar, any more questions on the docket?
We have about 30 more seconds.
All right, we'll go about 30 more seconds here. And again, going over our offer. Love to have you come and just jump on a phone call again, 5 to 7 calls we'll have over the next week or so. One-on-one strategy with myself and other advisors here at LifeWorks for your retirement strategy. Expert insight. Again, if you think something could be viewed upon or a different perspective than what you're getting, just give us a call. Let's set that meeting. Click on lifeworksadvisors.com/101 and set up a meeting with us. Yes, we are a licensed fiduciary advisory firm. We are fiduciaries. We take that very seriously. It's our job to put the needs and the wants of you before our own. So yes, we are fiduciary in that space. How do I start working with you? Well, it's a great question, and you can jump on a phone call with us, again, with setting up this one-on-one session. Again, lifeworksadvisors.com/101. We have a conversation to see if we can give you value and the next steps moving forward. So the first step is a conversation by setting up time with us. Love to do it. Reach on out. Love to have you again. And you do that through our Calendly link. So again, are we a licensed fiduciary advisor? Yes, we are a licensed fiduciary advisor. We take advising our clients very seriously. Putting your needs and wants before our own is how we get through our business. It's important we do that. You are first, we're second. Okay, any other questions, Skylar? How do we protect us against inflation? That's a great question right there. That is making sure that we're investing in right things to keep pace with inflation. Again, when we're talking about fixed income with the 2-year yield, 2-year treasury yielding us, 0.12%, inflation's 2-3% right now. Let's say it's 2%. The cash you have in fixed income actually has a negative rate of return, so you're losing value. So it's for us, we're trying to invest in some blue chip stocks, one that produce dividend, and again, participate in market upside capture while limiting that downside. So again, our portfolios, or one of them in particular, our protected portfolio does a really good job of limiting the downside risk while participating in that upside capture. So again, great question right there. We are located, great question as well, we are located in Grand Rapids, Michigan, and have a couple offices with some of our employees across the country, but a couple of them. But we are located in Grand Rapids, Michigan. How do I schedule a meeting? Again, great question. lifeworksadvisors.com/1on1. Click on the calendar that pops up. Pick a time that works for myself and you, as well as maybe 1 or 2 more advisors I'll bring in, and we'll start a meeting to have with you. Clients located again all over the country. We answered that. And I think we answered the fees as well. So I think we've had some great questions there. We appreciate you guys coming on board. Would love to talk to you soon. With that, wish you a happy Thursday, and we'll talk to you soon. Take care.